Hello everyone. Today is the 22nd of July 2026. And as I record this midweek update, the reality is starting to bite back very hard in the crude oil market. Reality is forcing the price higher and higher despite the persistent manipulation, which is not surprising at all. As I shared with you the last weekend, I expected the oil price to start looking like a staircase going upward. This is the result of manipulators being forced to release pressure from the crude oil pressure cooker so it doesn't explode, triggering a Armageddon in the oil market. As you can see in the second chart, this is exactly what continues to happen. But there is another very important thing I want to flag today. If the US government does not push the oil price back underneath the important $85 level, the tailwinds behind crude oil prices will strengthen. They will strengthen because between $85 and $90, many computer trading algorithms implementing momentum strategies are currently max short on oil. These momentum strategies will begin to be forced to cover their positions. The more they cover, the more intense the short squeeze will be in the oil market. To understand the whole technical picture, I would like to share a last observation about the end of July. As usual, this means portfolio managers will start rebalancing their position and especially window dressing. Window dressing is a deceptive practice used to manipulate financial reports and portfolios to make performances look strong. This is done right before a reporting period to attract investors or boost stock prices. Since the end of July is not a quarter end, the window dressing will be less intense. Banks and corporates will not be heavily involved because it won't show up in their quarterly earnings. For banks, it will only appear in internal reports shared regularly with regulators, which are less significant because they're private. Now, here is my observation. Assume you are a portfolio manager right now. Would you show your investors that you are still bearish on oil given the worsening Middle East situation? In my personal opinion, the very straightforward answer to this question is no. The reason why I would not be personally surprised to see a significant portfolio rebalance in markets heading into next week. This could eventually start benefiting energy companies, oil and gas explorers, and refiners. These companies remain incredibly undervalued considering all the current circumstances, as you can observe in this chart. Undervaluation that will become very clear when major oil companies report their Q2 earnings in about 2 weeks. Before the second part of today's update, I want to remind you about my premium content. Until Friday, you can subscribe to my Slice Finance portal, access my advanced research and analysis. You can claim a 7-day free trial to experience the new platform and read my sophisticated pieces, including very important analysis on oil, AI, trade ideas, and participate in my live streams and access the recording of the previous ones. You will find a link to claim the 7-day free trial in the description of this video. Now, in the second part of today's update, I have to talk about what is happening in the Middle East. I have been right all along for many weeks about the fictitious MOU and the ceasefire destined to fall apart. But while I was doing that, I received a good deal of criticism, but I'm used to that. People were reading Goldman Sachs, Morgan Stanley, and other research from prominent analysts who turned out far from being experts in their field. They acted like cheerleaders, claiming a supply surplus, an oil glut, even if the world would have started to refill its SPR. That was complete nonsense. But here I am, not taking a victory lap, let me be clear. I just want to stress that you must always do your own research and stick to the facts. Try to be objective so you are not carried away making decisions you might regret by those who can disseminate misleading analysis and commentaries. How does the future look? The situation is not boding well for the United States in the Middle East. Iran is in complete control of the Strait of Hormuz, with more tankers being disabled on a daily basis than the ones that successfully managed to cross it. It is also now official that the Houthis will enforce a blockade on Saudi shipping. This announcement was completely ignored by traders at the beginning of the week. They ignored it because of fake ceasefire news timely drop to trigger algorithmic selling. This caused a ridiculous move that dumped the price of crude oil below $80. Despite during the weekend, there was a major escalation in the war, with desalination plants being hit, oil facilities in Kuwait and storage facilities in Bahrain also being hit by Iran. Many tankers were disabled while trying to cross Strait of Hormuz under U.S. military escort. All of this was quickly forgotten by traders on Monday, who behaved stupidly, in my humble opinion. The Houthi announcement was ignored until ships started turning away from the Bab el-Mandeb Strait on Tuesday. At that point, it was impossible to stop the oil price from repricing to the next level because the impact to the global oil supply became undeniable. It reached the important $84.5 level and closed the gap open on the 2nd of March. Then it went sideways again as manipulation retreated and kept the price. Soon, the pressure inside the cooker will be too strong and force another step up. You must remain vigilant of all the news that will hit the tape. There will be narratives from President Trump, his height, and Iran to influence the crude oil market. They will trigger knee-jerk reactions from trading algorithms, especially during illiquid trading hours. From a fundamental perspective, both the Strait of Hormuz and Bab el-Mandeb are effectively closed. The global supply shortage of oil has potentially pumped to 20 million barrels a day. This is a supply shortage of high sulfur oil, critical for producing diesel, jet fuel, and heating oil. Heating oil is currently double the price compared to a year ago. The restocking season for the Northern Hemisphere winter has not even started yet, while commercial inventories have been heavily depleted. This might create significant pressure on oil prices, especially diesel, because of a lack of specific high sulfur oil supply, not a refinery bottleneck. The military balance is tilting towards Iran, leaving Trump with few options. Even without a full-scale war, pressure will build underneath crude oil. Personally, I don't expect President Trump to throw gasoline on a larger fire spreading in the crude oil market. He might agree to a new round of ceasefire negotiation welcomed by Iran to restock weapons and reposition. But during the next round of negotiation, Iran will test the potential to crystallize the gains they achieved in the past 5 months. They want full control of the Strait of Hormuz, but I don't think it will be acknowledged by Trump anytime soon. Maybe never. There will be a third and a potential 4th round of negotiations with military escalations in between. They will still make sure the war doesn't go out of control, especially heading into the US midterm elections. Trump has already complained that Iran wants to influence the outcome of that election. To be fair, I wouldn't blame them if that is their real short-term goal at this point. To conclude, the military confrontation is not going to end anytime soon. Potentially, it can drag on for all Trump's term, and I would not be surprised at all. Eventually, the Iranians will deal with the next president who promises to end the war. If you like my content, don't forget to like the video, subscribe to my channel, and turn on the notifications if you don't want to miss any of my future updates. Comments, suggestions, or feedbacks are always appreciated, so feel free to drop one in the comment section of this video. Thanks a lot for listening to my podcast today, for supporting me on X, for reading my research on JustDario.com, and for subscribing to my Slice Finance portal. I wish everyone a nice day. Bye.